Hi, this is Mike Bonfrisco. I'm an estate planning lawyer, accountant, and financial advisor in Cherry Hill, New Jersey. Over the past 20 years, I've helped thousands of families protect and preserve their assets. Today, I'm going to be talking to you about an IRA time bomb, an inheritance tax time bomb that was recently set, and then we're also going to talk about how to defuse that time bomb. For most families that I meet, their IRAs, retirement accounts, 401k, those types of accounts. Those are their biggest asset. When you add all those up, it ends up being their biggest asset or their second biggest asset after their house. And they often wonder what's going to happen to those accounts after they pass away. You see, an IRA is a good deal when you're putting money into it because you're deferring taxes. And in retirement, you pull that money out, usually at a low tax rate because you've retired, you don't have other income or as much other income, so your tax rate is pretty low. But what happens to that IRA after you pass away? Where does it go? Well, after you and your spouse pass away, oftentimes people leave it to their kids or other loved ones. Then what happens? Well, very quietly at the end of 2019, Congress passed a new law, and it was unanimous. They changed the way those accounts are going to be taxed, and it wasn't to your benefit. Here's how it works. After you pass away and leave that account to your children now have 10 years to withdraw that money out of the IRA. And that money is going to be taxed. It's going to be added to their income. So let's say you have $350,000 in your IRA, and you leave that to your daughter. Now your daughter's got a good job, she has a good income, she's making a good living. But that $350,000 that gets added to her income when she withdraws it, but she doesn't have a lot of time to do it. She only has 10 years after you pass away to make that withdrawal. So what could happen is, what often happens is all that money comes into their income, and if it's not done right, they could be paying 37% taxes on your IRA account. Did you ever think that a third of all that money was going to get taxed by the government? In this example, $100,000 going to the government? Is that what you want to see happen? Well, of course not. So what's the solution? Well, one solution we use to defuse this bomb is called a Roth conversion. So let me tell you how it works. In a Roth conversion, what's happening is you are systematically withdrawing money from your taxable IRA account and you're putting it into a Roth IRA. Now, a Roth is not like any other IRA. A Roth IRA works differently, and once you put the money into that Roth IRA, it never gets taxed again. When you pull that money out, it's tax-free. So by systematically withdrawing money from your taxable account and putting it into your Roth account, you leave that Roth IRA to your daughter or your son or your other loved ones. And they're going to diffuse that tax. They're going to reduce that tax. Now, we all know that taxes are a part of life. But in this example, like other areas of life, we can see that the smart person, the person who plans, the person who understands the rules, can reduce an unwanted tax. And this is how I help families reduce, eliminate unwanted taxes, and plan their estates effectively. If you found this information helpful, hit like and pass the video along to a friend or family member. Thanks for spending a few minutes with me.